Greetings traders, my name is Steve Gregor, otherwise known as the FX Coach. I've been trading and coaching now since, I've been trading since late 2003, early 2004, and been coaching pretty much everything after that, about a year and a half after that. So I've been coaching for a while now, and what I've done over the years is I've gone through the iterations of on-the-job training, learning what works and doesn't work, kind of like Edison. I know 10,000 ways how not to invent the light bulb. I've concluded that there are some things you can do to make life a little easier. I won't call them shortcuts, but they're things that make it a little easier. So today I'm going to talk about Calc 9.0, the latest iteration of my FX Traders Calculator. And I want to do a little overview video of how it works. Now, just a slight point of credibility. I've been in the Forex market for a while, I've suggested. I've achieved a few things there that are worth noting. One, I did bring the first technical analysis product to the computer, to the IBM PC world. I did get a PC Magazine Editor's Choice Award in a financial product shootout. I have an Inc. 500 Fastest Growing Company Award. I could go on, but the point is not to sound like I'm bragging. It's just to say when you get gray hair on the temples, everybody has achieved a few accomplishments. And in moving forward, I just want you to know that what I'm doing here is based on a sense of experience, wisdom gained through experience, and that just means years. Okay, side note, I do not have any babies running around, but I do have dogs, and so if they ever make any background noise, I apologize in advance, and hopefully they won't be too much of a distraction. That's what happens when you work from home sometimes. Eventually, I'll maybe get a broadcasting studio at home, but right now, I'm working out of my home office. So, that's enough about me. Let's get to Calc. Now, as I said, the Calc has lots of functionality in its 9.0 release. And that should tell you something right there, that it's in its 9th release, so it's been enhanced over the years since I first brought it out. And today the functionality is pretty broad, but its main goal originally was for position sizing. So you would know how many lots to put into a trade based on fixed risk, okay? And so let's go ahead and talk about that for a second. And the way I'm going to do that, and the way I'm going to help you understand and validate a little bit of what I'm doing here, is to use a third party to help validate that. And that third party happens to come in the form of iMarkets Live's harmonic scanner. And if you're not familiar with them, they're a large education portal with various offerings. If you want to know more about that, feel free to contact me. And in that world, they have as one of their offerings a harmonic scanner, which will automatically generate harmonic patterns, going back to the Gartleys and then everything else that's derived from that. Essentially taking the work of people like Scott Carney, who invested a lot of time and effort into stuff, and anybody that looks at harmonic patterns sure owes him a debt of gratitude for the contribution he's made to the marketplace. That being said, in this scanner, along with the programming to determine the scan and to paint it out on the chart for you, they give you other information like suggest, this PRZ, which is the potential reversal zone. Now, for you guys that don't have harmonic scans, don't worry about this. I'm going to give me about 30 seconds more. I'm going to get to the part where this validates my calculator. So what I want to show is they give you the entry zone. There's an entry zone start and an entry zone end. I just label them so. They put the pre-paint the stop loss line on the chart for you for this trade, and then they do some calculations to determine what the stop loss would be in that trade. Okay, and so with that, what I want to do is go over their calculations, and it's pretty simple. Let me grab my magic pen here, and I guess I'll use blue to contrast everything here. So what they say is if you're starting with a standard account and you have a $5,000 budget, or a $5,000 balance, and that's a standard account, and we're going to put 2% risk into the trade, and per their calculations for the scan entry, you have a 79.70 stop loss, then you could put 0.13 standard lots into the trade. So they're doing all the math for you. Now what they're utilizing is a formula that you can find yourself. Just Google it if you want to know. Search something like, how do I do fixed percentage risk as a Forex trader. How do I do position sizing as a Forex trader? And essentially, you're going to get this formula from numerous sources based on the hits of that search. And what it says is I'm going to take my account balance times my risk. I'm going to divide it by the stop loss times the value of a pip. And so what you're going to see here is they did just that. Here's the $5,000 balance right there. They were risking 2% into the trade. That's 100. They divided it by the stop loss times the value of a pip. In a standard account, the value of a pip is $10. In a mini account, it's $1. And in a micro or a mini micro, whatever you want to call it, it's 10 cents. So you go through that formula, you do the math, and you end up with 0.13 lots, as it's 125 is rounded up. Now, what you see here in the calculator is the same thing. We take that $5,000 balance that they had right here. We know it's a standard account, so the value of a pip is $10. We're putting 2% into the trade. We know we have a stop loss of $79.70. And when you hit the return button, it gives you 13 lots. The exact same thing that was calculated over here by the program and put out for you. The challenge when you're trading with this then is what happens if your account balance isn't $5,000? What happens when it's $7,287? And what if you feel like you want to put 1.5% risk in the trade? See, they'll show you the 2%, they'll show you the 1%, they'll show you 3%, but let's say you just want to put 1.5% into the trade. And let's say you don't have the $79.70 stop loss, you have a 4-hour trade and you got a 148 pip stop loss. So all of a sudden things get a little confusing. What you don't want to do is just put 13 lots in your trade. All right, or ask a fellow trader, how many lots are you putting in that trade on the scan? See, his number should be different from yours because it should be based on his account balance. It should be based on the risk he wants in the trade. It should depend on the size stop loss. So these don't just go trading randomly. And quite frankly, in today's Forex world, there's a lot of talk about lots, position sizing coming down the lots. That's incorrect. Position sizing comes down to what percentage you want to trade. So there's no confusion there. It doesn't matter whether you have a $100 account or a $5,000 account or a $100,000 account. 2% is 2%. Instead of working backwards through the math, it's arcane. I don't understand it. So this is the way serious Forex traders work risk. It uses this formula. It's available all over the internet. It's nothing secret. And I've just shown you that inside the MT4 program to generate this harmonic scan where they're calculating how many lots to put into the trade based on some assumptions. $5,000 account, standard account, 2% risk in the trade, 79.7 stop loss. It yielded 0.13 lots into the trade as the position size, and the calculator does exactly the same thing. It's just this lets you adjust these variables, whereas these are assumptions that they give you. So if my variables change, I can determine what my actual lot size should be. And the reason is you want 2% into the trade to take advantage of the leverage and the compounding that the Forex affords you. If you don't want to take advantage of that, you might as well just go trade stocks or something else or flip real estate. The Forex has the fastest way to compound money due to leveraging and due to the compounding, but you've got to trade properly. Now what will happen, obviously, as your account grows, when you put 2% into a trade, the amount of money at risk is larger, but it's still 2% of the account. And your mental side, the mental game, should grow with you to accommodate yourself trading larger dollar amounts, even though it's still 2% into the trade. So whether you have a $100 account or whether you have a $500,000 account, if both of you lose with 2% into the trade, you both lose 2% of your account. And likewise, if your account shrinks, hopefully not, then when you lose your 2%, you're losing a smaller amount because this amount here will be smaller as well. All right, so we've got a validator on the outside. First of all, here's the formula. You can find it via Google. Here's an example of that formula at work. And then here's Trade Calc doing the exact same thing, coming up the exact same concluding number. So there's your validator for what I'm really doing with Trade Calc in terms of position sizing. So let's go in here to real Trade Calc. And again, as we go through the same example and we come here to this field, which now appears to be locked again. No, it's not. I had an issue this morning where it locked up as I was trying to record the video. 79.70, And boom, there it is. We get our 0.13 lots into the trade. All right. And of course, it does round it up. It tells us that our stop loss was 80. Now, so that's the position sizing part. So we've already validated that with, the IML scanner. And now we're showing you how it works in here. So what happens then, of course, if your account balance was different? What if it was $7,876? And what if you wanted to put 1.5% into the trade instead of 2? And what if your stop loss was 148.2 pips? Then we can put 0.08 standard lots into the trade. Pretty cool, pretty simple. What if I was in a mini account right here where the value of a pip was $1 instead of $10? All right, and we hit our return. What do you think is going to happen to that 0.08? 80. Well, in this case, 81, the magic of decimals when you start doing this stuff. So, and what happens if this was a dime account, a micro account, one of those $50 accounts? 0.10 cents, right? $0.1, whoops. $0.1, which is 10 cents, micro account, right? Then I can trade 8.08 lots. Okay? So it automatically adjusts. Now, one quick comment about the value of a pip. You got a calculator like this, it'll be precise. It'll let you have the right calculations, okay? Because a lot of times people just kind of slough it off and are not accurate with this. And you want to be accurate with this because it's your money. It's your business, okay? So let me get back to the standard offering here so we can kind of make sense of an example I want to show you. Now I'm going to take this a little deeper, and if this confuses you, I'm sorry, but this is the stuff you need to learn as a trader. So if other people aren't showing you this in the Forex world, that's not really my fault, okay? It's not really my fault. But if you want to be a trader, you got to learn how to do this, okay? So let's go back to that 79.7 example. Now, everything here is pretty simple. I got my count. I know it's a standard account. I know I'm putting 2% risk in the trade, and I know my stop loss, okay? Notice this is neutral. It doesn't ask what currency pair. So this calculator, when it went all the way back to version 1.0, was based on the Euro USD, okay? Any USD quoted pair, which means the USD is the second designator in the currency pair. That's the quoted pair. And so for the USD in accounts that are based on USD, these nice round numbers make sense. It's 10 and $1 in a mini account and 10 cents in a micro account. But what if you're trading other pairs? How does that impact this? Well, the reality is they're going to have a higher or lower pip value, which is going to affect the number of lots you can put into the trade. But then the number of lots in the trade will be multiplied back by that pip value to determine your earnings. Here's what I mean. Let's say we're in this trade with a stop loss of 79.7 pips, and let's say we made 150 pips in the trade. All right, so we made 150 pips. You're going to see some calculations show up down here now based on, oh, that's margin, I'm sorry. Down here, let's say we made 150 pips in the trade. It shows us our profit. We had 150 chart pips. We had 0.13 lots in the trade. That's as if we had a gain of 19 lots altogether. They're paying out at 13 cents. Excuse me, they're paying out at $10 a lot. And so it ends up being $188, $190, okay? The actual profit was $188. Now, what happens if this was a different pair? What happens if this was, let's pick one that's way out there, the euro pound, all right? So what you're going to need to do then is to calculate the value of a pip for the euro pound. How do you do that? I'm not going to go through that exercise. That's something you can do on your own. Very often, brokers will have that listed right on their site. They'll tell you the value of the pip for each one of their pairs. Again, the most predominant one is $10 because that's the euro, the USD one. But the others will vary. Just as an example, I'm going to take you to one of my community websites for my trading team, pipclub.com, and we're going to come down here. And this site is totally being redone, but let me just get to this calculator, resources, and here's a pip calculator. So what this does is it takes the current trading price for the currency pair, and it tells you the value of a pip, whether you're on a standard, okay, which is $10 account, $100,000 contract, a mini account, which is a $10,000 contract, or $1, or the micro account, which is a $1,000 contract, or a $1,000 contract, which is 10 cents a lot. Okay, so we know this is $10, this is 1, and this is 10 cents. So if we go to the Euro USD, let's go there first. There we see standard account $10, mini account $1, micro account 10 cents, and you'll see that repeated in some of these other accounts that are Euro USD based. Okay, there's the pound, the Kiwi. Okay, same numbers you're going to see. $10 shows the currency price, but go down to something like the Euro pound. And what we can see then is for a standard account, the value of a pip is $13.59. $13.59. So let's go back to our calculator. And now let's say we're using the Euro pound in a standard account. Everything else is the same by 5,000, 2%, and the stop loss the same. So let's put $13.59 because that was the value of the pound. That was the value of the pip for a standard account in the euro dollar. And now instead of 0.13, notice it says I can trade 0.9 standard lots. Okay, not the same as we had before with 0.13. So we can trade less lots. Okay, pretty interesting, huh? Because what does less lots mean? When we put our margin on deposit for that account, we have to pay less margin. We have to pay less margin. Well, what happens when we make the 79.7 pips? Funny thing, we made the same $188. How does that work? That's because the chart pips that you make get multiplied now by the 1359. Well, excuse me. Yeah. And so what ends up happening then is, we have 150 pips, and that's the projected. We actually have 14 when we multiply it times the value of the pip. And so the 1359 times that gives us the 188. So we make the same amount of profit regardless of the pair and regardless of the value of a pip. And that's why a lot of people slough it off. The important thing to understand here, though, is if I trade something here where the pair is greater than $10, it lets me put in less lots into the trade, but I'm still going to make the same money. But with the less lots into the trade, guess what? I have more room to put other trades in based on margin requirements. So if you're a US trader and you have limitations because of 50 to 1, how much you can actually have into a trade, this allows you now maybe to have 2 full trades because it's pulling less of my deposit per trade. Now, if that's too confusing to you, you'll get there. I'm just saying it doesn't matter what the value of a pip is. If you want to be thorough, I would put in the actual value of a pip. You need to learn which currency pairs cost more or cost less because they have, other implications. Likewise, if I trade one that's much smaller, it's going to be the opposite effect. I'm going to be able to put more lots into the trade. Well, that sounds nice, but you're going to yield the same profit no matter what. It'll be less lots, but the problem is it's going to require more margin. I mean, more lots, but it's going to require more margin. So not a ton of difference in terms of position sizing as far as the calculations you go through, but it is because there's different numbers of lots. So standard account, USD, it does the calculations for you. So this is precise, this is precision, this is how you maintain exactly 2% into each trade. Okay. And there you have the little red dot. So let me talk about the little red dots. As you see the calculator, you'll see some areas, there's these little red stars or asterisks or whatever after the name of the variable that we're looking for. Starting all the way up here with important notice. And when you hover over that with your mouse, you're going to get the disclaimer, which is very important to understand. And you're essentially accepting that disclaimer when you use the calculator. In other areas, it's going to tell you value of a pip. Oh, let's go check that out. The value of a pip, it's required for the calculator. Value of a pip is dependent on the type of account and the currency pair being traded. Most of the time, USD-based currency pairs, you would use the following. Boom, 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 just like we talked about. Okay, micro account, mini account, standard account. So everything here is pretty self-explainable. One note on this calculator, it's done in as an Excel file that has an XLS extension, which means you should be able to run it just fine on Excel, and you should be able to run it just fine on products like OpenOffice, which will import the Excel file for you. If it doesn't run, I don't know what to tell you. It works just fine as you're seeing it right here. Okay, so let's go on to a couple things. So the second thing was we talked about it does show you some profit analysis. So not only does it help you in determining the correct number of lots to put into your trade based on the given circumstances, it also gives you some profit analysis. What if I did make 150 pips in the trade? And as I showed you here, it does those calculations for you in terms of showing you this whole block based on target profit in trade, all the way down here. All right, so what it says is with 150 pips, as projected, or if I actually made that, the total pips, which is your lots times the chart pips, okay, lots up here times chart pips, equals 19. Potential gain with the projected profit pips is $188. Your reward to risk is 1.9 to 1. So it's really gain to risk if the trade was past tense. And you only need 1/2 of a trade to break even. And that kind of makes sense. If I'm trading a 79 pip stop loss and I'm making 150 pips, if I gain half of that, i.e. if I gain 75 pips, I'm essentially making break even. All right, hope you can see the math there. Pretty simple. So I only need 0.5 trades to break even. Meaning if I lost this trade, half a trade, winning half this amount will give me back to break even, or very close. At 150 pips with 2% into my trade, 150 pips equals 3.76% return. Obviously, we gain the same amount of pips in a gain as we do the loss. So if we have 79 pips and we back up those 79 pips, we lose 2% of our count. That's to the negative side. On the positive side, what happens if we gain? Well, every 79.7 pips, we gain 2%. So going 150 pips, we gain our first 2% at 79.7. We're not quite at 160, and that's why it's a little less than 4%. Calculates it out, 3.76%. Another way of using that this gain tool is to say, well, what if I wanted to gain, let's pick a number. Let's say I wanted to have a monthly return of 20%. Then it tells us, well, on this trade you made 3.76%. You're looking for 20% a month. You really have to earn 797 chart pips, or if you could duplicate this trade 5.3 times, you'll make your 20% a month. So additional insight, just a little additional insight to tell you, about where you are, if you're on target, etc. Pretty good information. All right, another real powerful thing that Trade Calc does, and it depends on your orientation, is it allows you to do side-by-side comparisons. What if you had some technical tools or some things in your arsenal that allowed you to have something a little tighter than the 79.7 pip stop loss? What if you had some tools that, even though the scan came in and said we're recommending an 80 pip stop loss here, what if you had some tools that let you use a 40 pip stop loss? They brought you a little bit more precision. You can be a little bit more assured. So now we're going to run this as a side-by-side comparison. Everything else remains the same, right? We're still trading in a standard account. We still have a $5,000 balance. We're still putting 2% into the trade. It's just in one trade, we're going to run the math with the 79.7 pips stop loss, and this one we're going to run with 40. And when we do the side by side on that, let me go ahead and hit the return on that, we get the second side of the chart to populate. And as you can see, by using the tighter stop loss, instead of 80, we're using 40, we get to put more lots into the trade. 0.25 versus the 0.13. When you have more lots into the trade, you get to make more profit. And there's a determination here, and I should have reviewed that, but we'll pick it up right in here. So in addition to this 0.13 lots into the trade, it tells you what your profit per pip will be in your trade. It's going to be $1.25 profit per pip made. And it takes all that from this information. It tells you how much you're going to make. So if you make, you can calculate it out. Hey, if this goes 100 pips, what am I going to make? If it goes 500 pips, what am I going to make? It's $125 per pip. Over here, because we used a tighter stop loss and we could put more lots into the trade, we're making more per pip. I get to make $2.50 per pip versus $1.25. Ooh, pretty interesting. Same size account, same standard account, same risk into the trade. If we both lose, we lose 2%. But on the 70 pips, 79.7 pips gained, over here, I would be making $1.25 versus $2.50. And that's why when you get down to the gain, $188, $375. So we take what this potential per pip is, multiply it by the actual pips made, and there's your result. The potential per pip here times the actual pips gained, there's your result. So you can compare them. Now, if that doesn't motivate you to want to learn how to trade with a tighter stop loss, you just can't randomly use a tighter stop loss. You have to have the technology to be able to do it. Now, just as a point of curiosity or a point of interest, most of my traders, through some of the technology we use, call it trading in the new paradigm, a lot of the time, most of the time, we're in here with 10 pip stop losses. And that's, yes, even on big trades. Sometimes it's 20. But let's talk about a standard 30-minute kind of trade. So we're in there with a 10 pip stop loss. It allows us to put a lot more pips into the trade. Instead of lots into the trade. Instead of 0.13, I'm putting a whole standard lot into the trade. And yet if we lose, we both lose the same 2%. At risk in the trade, 2% of our account, $100. At risk in the trade, 2% of the account, $100. The difference is this guy over here is making 2% every 79 pips. This guy over here is making 2% every 10 pips. So in that same trade, that goes that went 150 pips with the 79.7 stop loss, call it 80. Let me erase this, get too many things circled. So with the 79.7 pip stop loss, and we put 1/3 into the trade. With the 10 pip stop loss, 1/3, 0.13 standard lots. The 10 pip stop loss, we can put one standard lot into the trade. So now when it goes 150 pips, he makes, as we said, $188. When this goes the same 150 pips, he makes $1,500. Pretty interesting, huh? Pretty interesting. So it does let you do side-by-side comparisons if you ever have a need for that or desire for that. So that's pretty powerful. Another thing it lets you do is do calculations for legging down. Okay? And all it really says is it takes your standard information up here, okay, and it predetermines, or you determine what you did. So let's say you were going to have, now some people call this various things. If you want to leg down once, in other words, take out 50% of your lots in a leg down, and then end the trade with the other 50%. I've heard, some people refer to that as twin trading. Well, that's nice, but what if I want to have 4 leg downs? What if I have 4 nice spots, or 5 or 6? So what we want to do is be able to calculate what we do. Let's say we have a trade that goes from start to end, goes 200 pips. But we leg down 4 times. We leg down at 50 pips, and we leg down at 100 pips, and we leg down at 150 pips, and the last set of lots we took out at the 200 pip gain. So let's say we took out 25% along the way, okay, or something like that. So now we would never just randomly leg down. We should have some sort of chart-based, targeting for stop loss movement and taking down lots. If you want to leg down, some traders will just stay in all the way and then just get stopped out. Other traders prefer to leg down along the way. They think there's a difference in risk. There's not, but that's okay. Whatever suits them mentally. So let's look at the calculator here, and let's say I went, as I said, 50 pips, and I took out 25% of my lots. So let's just say I was able to trade 100 micro lots, which is the same as one standard lot, right? And so let's say I had 100 lots into the trade, and I'm going to leg down 25 lots at each target. So I leg down here, lots out, I take out 25. And then over here, my next target goes another 50 pips. Well, that's 100 pips total, and I'm going to take out 25 pips there. 25 lots there. And then it gets to my third target, which was 150 pips, and I'm going to leg out 25 lots there. Now I only have 25 lots left, and of course we reach our final target, and there's some pullback against me, and I feel, hey, why risk it? Let's put this in the bank. So I take out my last 25 lots. All right. So what it tells you is you had 100 lots into the trade, which is correct. We know you had a total of 12,500 pips gained. Now again, that's a pip, chart pips. 25 times 50, 25 times 100, 25 times 150, 25 times 200. Boom. Average profit in trade, average profit per lot in the trade is 125. So what this says is my trade that went 200 pips, where I entered with 100 lots and I legged down progressively. The trade that went 200 pips, where I legged down, in this case, at every target, 25%, this 200 pip trade where I legged down is equivalent to having me stayed in the trade with everything, and the trade went 125 pips. It also means I could take whatever the profit per pip potential is and use that and multiply it by the 125 to see what I would have made in that trade. So this is a real handy calculator. It doesn't require anything other than knowing the distance the pips went in this. And then you can take these numbers and do the math with anything else you want with it. This is just a way. See, it's a little deceiving. You'd be a little deceiving if you said to your buddy, hey, I made 125 pips in that trade last night. Because what that really means is, I made 200 pips in that trade last night. Because that really says you were in there full lots for 200 pips. If you leg down along the way, that's not true. This trade, you made 50 pips. This trade, you made 100 pips. This trade, you made 150 pips. The last lot is the only one. The last set of lots, the last 25 lots, are the only ones that actually went 200. But when you weight average all those out, it's the same as if all your lots stayed in for a 125 pip trade. That's pretty powerful. All right, this middle block here is kind of fun. And all this says is, it's pulling value from what you have up here, but you can write what you want in here. No, you can't. You can only adjust this. So if you were told you could put 0.13 lots into the trade, and instead of the 79, pip stop loss, you used, 80 is close enough, and that's why it says this is a 2.1% return, because you just went fractionally over. It was enough to round it up. Okay, so that's essentially the same as this stop loss. Well, guess what? You had 2% into the trade. If you go your 80 pips, you're going to make your 2%. Bingo. But what if you tightened up your stop loss? You used 33 pips for your stop loss. Okay. Well, what's going to happen is this looks a little backwards at first, doesn't it? You think, well, I should make more pips here. But we're not doing a lot calculation here. We're saying we have a standard number of lots. We already or a standard. We have a calculated number of lots in the trade. So if I take myself out at 33 pips, or I take my stop out at 33 pips, I will have only lost 0.9%. If I stay in for the full stop loss, I lose my 2%. If I take myself out early, this shows you what you would actually experience in your account. So the number of lots is not, this is not a calculator here to determine position sizing. It's assuming your position sizing was 0.13. So if I put 13 lots into the trade, all it says is if I enter the trade here and it backs up the full 80 pips, I've lost my 2%. But as it's backing up, if I took myself out at 33 pips, what would that really be in terms of a loss? It'd be 0.9% of a loss. It's kind of an interesting way of looking at things. Not that you want to take yourself out early, but it's the consequence if you do. This trade may, if your system designer told you you needed the 100 pip stop or the 80 pip stop loss, and you took yourself out here, well, this trade very well may come down here, take you out, and then continue up, and it would have never taken you out at the recommended stop loss setting. So it just depends on what system you're trading. But it does show you the value in understanding how it's going to determine your actual loss or your actual gain if you start switching the stop loss once you're in the trade. You've already committed to the 0.13 lots in this case. If that seems a little over your head, don't worry about it. You don't have to use that section right now. Others that can take advantage of that, do that. Over on the right, the last thing that's available in Trade Calc is pretty simple. All this really says is if I'm trading 2% risk into the trade, what happens if I get a bad mentality and I start slipping? That's why it says around the edges. It's around the edges of the percent you put into the trade. So with my trade, sharpen my pencil here. With my trade, I put, and this is rough calculations because I'm not going out multiple decimal places here. If I have 2% into the trade, remember at risk is $100. Well, what happens if I take that and all of a sudden I put more lots into the trade, increasing my risk? Well, if I go at 2.5%, then I'm risking 125%, $125. If I put 3% into the trade, I'm risking $150. So what this does is it says, okay, this helps combat the mentality of, oh, just put 1.3 lots in your trade, and you have no idea how that was derived, and so you come along on an account with $3,000 or $2,000 or $1,500, and you have no idea what your risk is. All you know is, oh, they said to put 0.13 lots into the trade, so you do that, right? Well, you'll get a varying percentage. If this was calculated correctly, and you put 0.13 in based on your account size and whatnot, and your 2%, then it's very accurately reflected. What this shows is what happens to those traders, and I've seen them, when they start putting in more and more and more. They risk 5%. All right, well, it's jumping up based on your situation. Your risk in the trade just went from $100 to $250. So when you lose that trade, it's minus $250 versus minus 100. So just putting in more lots randomly, I'm going to go from 0.1 to 0.3. I mean, I've seen traders that are putting in, like one standard a lot when they should be in there with a third of that. They have no idea. They're just, oh, I'm going to be cool, put in a standard lot. They have no idea what amount of lots they really should be putting into the trade. Nonetheless, that they would be gambling like that. So this is just around the edges. It tells you the implications of less lots into the trade or more lots into the trade and what that does to your risk. And it does pull this data from the 2% that you put in, okay, which is pretty interesting. All right, so that covers the basics of Trade Calc. Again, the main function of Trade Calc is to do position sizing no matter how big your account is, no matter what risk you want to run, whether you're in a standard account or a mini account or a dime account, regardless of your stop loss. It'll take all those variables and tell you exactly how many lots to put into a trade to maintain this level of risk in your trading. And if you want to be a 1% trader to start out, that's very fine. We recommend that a lot for people. But nonetheless, then it's 1% in every trade. As your account grows, you still want it to be 1%. If you don't do that, if you just keep putting in the same number of lots as you progressively move forward, your account is going to be stymied with its growth. It'll still grow. It's just not going to grow the exponential way it could grow. You don't want to take your account, slowly build it from $500 to $5,000, and you're still trading 0.13 lots. If you can master your trading and you have your win percentages and your mental games right, oh my gosh, it should be much, much more than that. Because every time your account grows and you put in the same number of lots, you're risking less and less and less at each trade. And so your gains are going to be less and less as well. So you want to take advantage of what the Forex gives you. You want to take advantage of compounding, leveraging, which lets you make your trades and put in these lots, and then compounding, which means when you win, it'll take your account exponentially faster versus just a kind of a linear growth. All right, and this is what you want, my friends. So Trade Calc is out there. It helps you do proper position sizing, and I hope you enjoy the product. As it says here at the very bottom, right here, if you have any ideas, suggestions, or comments, please write me, okay? I'm not really here to support your use of this product. That's what this video is for. You're going to have to get a little smarter to understand what I've covered, if what I've covered is over your head. As far as why do you need to do this, it's so you can do your proper position sizing, so you know what you're actually risking in the trade. If you don't know what you're doing here with the number of lots you're putting in the trade, you have no idea what you're risking in your trade. And my friends, that's called gambling. You got to decide whether you want to be a trader or a gambler. And being a trader requires, a little bit of understanding of what's going on. I hope you enjoy this product. And again, if you have any questions, just write me at stevegregor@pipclub.com. You can also be at thefxcoach.com. There's a contact link there where you can contact me there as well. Thank you very much, and I hope you have a great day. And on your Forex journey, I definitely wish you a whole ton of pips. Y'all take care.